In the offshore world, money doesn't look the way you imagine it does. It doesn't glow on screens, it doesn't sit neatly in vaults, and it doesn't wait politely for someone to request it. Out here, beyond the borders of official balance sheets, the dollar becomes something else, entirely an invisible pulse moving through cables, contracts, whispered promises, and institutional memories too old and too bruised to trust the surface narrative anymore. You can't see offshore dollars, but you can feel when they disappear. The way a room's air shifts before a storm arrives, or how the ground stiffens just before a fault line trembles. And tonight, as you walk deeper into the maze of cross-border funding desks, synthetic claims, and liquidity swaps that never make it into mainstream textbooks, you can sense something tightening, something subtle, something dangerous. The kind of tightening that doesn't announce itself with alarms, but with silence. A silence so heavy, even veteran traders recognize it in their chest before they see it in their screens. Offshore USD shortages never start with a headline or a failed auction. They begin with hesitation the moment a bank in Singapore rolls a position 3 hours later than usual, or a dealer in London quotes a spread just slightly wider than yesterday, or a funding call that normally recycles itself. Without question, suddenly comes with a pause. The pause is everything. Because in the hidden dollar system, a pause means distrust, and distrust is fatal. You step closer into this dimly lit world. A world where trillions in obligations are balanced on top of nothing more than confidence that offshore banks can always find dollars somewhere, somehow, at a price. But what happens when the system flinches? When the offshore machine that powers global trade, debts, commodities, and shadow balance sheets begins to starve for the very currency it was built to replicate. That's the part no one tells you. That's the file you were never supposed to read. Every crisis of the past 40 years left fingerprints here. In this place, in this fragile, unregulated ecosystem where the dollar's shadow self grows and contracts in ways no government can fully measure. And now you're standing at the edge of another contraction, subtle, quiet, creeping through FX swaps, cross-border funding channels, and synthetic liabilities that bend under stress long before breaking. The story of offshore dollar shortages does not begin in a crisis year, nor in a recession, nor in any moment of dramatic financial collapse. It begins in the quiet, unremarkable decades when the global financial system was still learning to walk on two legs and discovering that it could, without anyone explicitly approving it, create dollars outside the United States. The offshore dollar, what would later be called the eurodollar, was not invented in Washington, nor supervised by the Federal Reserve, nor placed under any coherent regulatory architecture. It grew like an organism in the dark, nourished by incentives rather than laws, by necessity rather than design. In the 1950s, when the Soviet Union feared the United States might freeze its dollar deposits, it placed them in European banks, a small decision that opened a breach in the monetary order. Those dollars were still dollars, but now they existed beyond the reach of American oversight. European banks realized something quietly revolutionary. If a dollar deposit could exist outside the United States, then so could a dollar loan. And if they could lend dollars they did not physically possess, as long as they could find a counterparty willing to accept the liability, then the offshore dollar system could expand without limit. The world didn't notice at first because the numbers were small, the markets were young, and the plumbing was primitive. But the logic was already in motion. Global finance had discovered that it could mint its own version of the world's reserve currency. And once that discovery took hold, no government, not even the United States, could stop it. By the late 1960s, offshore dollar balances were growing faster than onshore ones. A quiet explosion that resumed again after the collapse of Bretton Woods in 1971. When the dollar was severed from gold, it did not weaken. It multiplied because the world needed a medium for trade, credit, settlement, and leverage. Without gold constraints, offshore markets were the first to scale. free from domestic reserve requirements and the regulatory burden placed on U.S. banks. It was in this period that shortages first revealed themselves not in the headlines, but in the money market spreads that diverged under stress. Banks in London or Zurich occasionally struggled to roll positions. Liquidity dried just enough to signal discomfort. And central banks scrambled behind the scenes to supply dollar swaps long before such tools became formalized. The lie people believed at the time was simple. The Federal Reserve controlled the dollar. The truth was far stranger. London did. Zurich did. Tokyo did. Any financial center with access to interbank markets did. And because these offshore markets created dollar liabilities without creating dollar reserves, the system grew tall and hollow, stretching upward faster than its foundation could support. In the 1980s, as global trade accelerated and deregulation opened the floodgates, offshore banks extended synthetic dollar credit at a scale that no official institution dared to estimate. This was a machine without meters, a factory running without gauges, producing a currency backed not by gold, not by sovereign decree, but by confidence in interbank rolls. The cracks appeared during the Latin American debt crisis, when dollar lenders discovered their liquidity was thinner than expected. But the deeper revelation arrived in the 1990s, when cross-currency basis swaps emerged as the instrument of last resort for institutions desperate to acquire offshore dollars. A negative basis, something that should not exist in a frictionless market, was the market's first admission that synthetic dollars could evaporate faster than they were created. The leak that exposed the foundation came during the 2007-2008 crisis, when U.S. policymakers were shocked to discover that dollar shortages were happening not in America, but in Europe. The largest banks requiring emergency support were not in New York. They were in London, Paris, Frankfurt, and Zurich. The Federal Reserve, for all its domestic authority, realized it had to rescue a banking system it did not regulate, did not supervise, and did not fully understand. The creation of unlimited swap lines was the closest thing to a confession the financial world has ever seen. The offshore dollar system was bigger than the Fed's domestic one, and the only way to prevent its collapse was to supply dollars at scale. After 2008, the shadow dollar resurfaced again in 2011 during the Eurozone crisis, when European banks scrambled for funding as U.S. money market funds pulled back. Again, the dollar shortage did not appear in American data. It appeared in cross-border spreads, LIBOR stress, and the stubborn refusal of offshore lenders to roll positions at reasonable rates. The world saw echoes of the same pattern in 2015 after China's growth scare, in 2018 during the Federal Reserve's tightening cycle, and in 2020 during the violent dash for cash. Each episode revealed the same uncomfortable truth. Offshore markets could create more dollar liabilities than global institutions could reliably support. What changed after 2020 was not the mechanism itself, but the scale. Balance sheets became more interconnected, derivatives more complex, and global trade more dependent on synthetic USD funding channels. Banks believed they could handle it because the Fed had demonstrated that it would step in every time. But that belief was the quiet, dangerous lie. The Fed could step in, but only after the damage had already begun. Offshore dollar shortages form long before the public sees anything, long before central banks issue statements, long before swap lines open, long before volatility spikes. The shortage begins in the hesitation, in the widening spread, in the subtle tightening of funding flows across Singapore, Hong Kong, London, and the Middle East. It begins when a bank suppresses its internal alerts, convincing itself that the stress is temporary. It begins when liquidity desks extend exposures slightly beyond their comfort zone. It begins when global institutions forget that offshore dollars are not real dollars, but promises layered upon promises. And every promise, in the end, is only as strong as the one who keeps it. The historical arc of this system from the Soviet deposits of the 1950s to the synthetic swaps of the 2020s shows one thing clearly. offshore dollar shortages are not anomalies. They are features. They are the system revealing its weakest point. And every time they surface, the world learns again that the shadow dollar is not infinite, not stable, and not truly controlled by the institutions everyone assumes are in charge. The twist in the offshore dollar story arrives quietly, in a moment that feels almost accidental, an inflection point where the system reveals that it has changed without telling anyone. It doesn't happen when spreads blow out or when central banks panic. It happens earlier, in the split-second realization that the offshore dollar machine no longer behaves like the world assumed it did. For decades, the belief was simple. As long as global trade expanded and financial markets grew deeper, offshore banks could always create synthetic dollars to meet demand. But slowly, almost imperceptibly, the architecture shifted. Derivative contracts became longer and more complex. Cross-currency swaps became the backbone of multinational funding, and regulatory reforms after 2008 forced banks to hold more capital onshore, leaving their offshore desks thinner, more brittle, and increasingly dependent on a network of counterparties that had their own pressures to manage. The world didn't notice this shift because it didn't look like a crisis. It looked like efficiency. It looked like liquidity. It looked like the system operating smoothly. But beneath that surface was the new reality. Offshore dollar creation had begun to depend not on confidence alone, but on the capacity of a shrinking set of institutions willing to extend balance sheet space for synthetic USD exposure. The pivot moment often comes when a major bank, usually one with global reach, quietly reduces its swap book, reroutes exposures, or stops quoting aggressively in the interbank market. When that happens, the absence is not immediately visible. Screens don't flash, headlines don't report it, and regulators don't announce it. But the offshore network feels it. A dealer in Tokyo receives a rate slightly worse than expected and hesitates to extend. A bank in Dubai rolls funding but shortens the tenor to overnight. A Singapore desk widens its internal risk buffers just enough to reduce its willingness to lend in size. These micro-adjustments, individually harmless, collectively mark the moment the system pivots from abundance to scarcity. The twist is that by the time offshore players notice tighter conditions, the shortages have already been seeded. A synthetic dollar liability created yesterday now weighs heavier than a similar liability created a decade ago, because the chain of institutions that once recycled these exposures has thinned. This thinning is the hidden fracture, the point where risk moves from a theoretical concept to a structural constraint. And inside institutions, analysts begin asking questions that feel like warnings. Why is our short-term funding rolling at a premium? Why hasn't our counterparty quoted size this week? Why has the basis widened even though policy rates haven't moved? These are not the questions of crisis. They are the questions of awakening. For the first time in years, the offshore dollar machine signals that it cannot scale infinitely. And then comes the sharp breath, the one insiders recognize instantly. A large participant pulls back. Not dramatically, not with an announcement, just a simple internal decision to reduce risk. And because the offshore dollar system is built on layers of leverage, that single decision forces others to adjust. It spreads like pressure in a closed pipe, echoing through invisible channels. Suddenly, dollar funding that was available yesterday now feels conditional. Tenors shorten. Quotes become selective. The basis widens again. And in that widening lies the twist. The system is no longer functioning on confidence. It is functioning on fear. Not fear of collapse, but fear of capacity. The fear that someone else might stop providing dollars first. This is the truth hidden beneath the charts, the realization that offshore dollar shortages are not triggered by external shocks, but by internal recalibrations, by risk managers tightening invisible screws, by institutions quietly protecting themselves. And once that shift happens, the shortage accelerates on its own. Because every participant who senses stress behaves in a way that deepens the stress. The offshore dollar machine, once celebrated for its flexibility and reach, reveals its flaw. When scarcity begins, it reinforces itself. And by the time the world sees the first signs, the system has already crossed the point where liquidity becomes fragility. The hidden architecture of offshore dollar shortages can only be understood by tracing how the synthetic dollar engine actually functions inside banks, across borders, and through the derivative networks that now substitute for traditional monetary channels. At its core, the offshore dollar system is a ledger made of promises, balance sheet, claims that behave like dollars, even though no physical dollars ever move. When a bank in Singapore lends a US dollar to a client, it often does so by creating a liability on its balance sheet and offsetting it through short-term borrowing in the interbank market. FX swaps or cross-currency basis trades that synthetically generate dollars. This means the dollar the borrower receives is not a Federal Reserve-created reserve. It is a contractual obligation dependent on a chain of counterparties. As long as those counterparties can roll their own exposures, liquidity appears abundant. But the moment any link hesitates, the shortage begins. One of the most important insights comes from observing how offshore banks manage their USD books relative to global trade flows. According to the Bank for International Settlements (BS), by 2022 non-U.S. banks held over $14 trillion in USD-denominated liabilities, a figure larger than the GDP of China. Of these, roughly $5 trillion were short-term, is less than or equal to 1 year, meaning they must be rolled constantly. This rollover dependency is the first structural vulnerability. If a bank cannot roll a short-term liability, the synthetic dollar it created instantly becomes unstable. But the offshore system's fragility deepens because most of these liabilities are hedged using FX swaps, which convert foreign currency into synthetic dollars. The BIS has repeatedly shown that the global FX swap market exceeds $80 trillion in notional value, dwarfing global GDP. Within that $80 trillion, significant share, dollar tellers 6 united at over $35 trillion, represents synthetic dollar funding needs. This means the world's largest source of dollar demand is not trade, investment, or reserves. It is hedging. Hedging that must be rolled, repriced, and recalibrated constantly. Offshore dollar shortages, therefore, emerge not when banks run out of dollars, but when derivative markets tighten their ability to create synthetic ones. The mechanism unfolds in predictable but invisible stages. First, cross-currency basis spreads begin to deviate from theoretical parity. For example, the USD-JPY basis has historically been a sensitive indicator. During stress periods like late 2011 or March 2020, the basis widened sharply as Japanese banks scrambled to secure dollars. When the USD-JPY 3-month basis hit minus 120 BPs in March 2020, it signaled not a lack of dollars in the US, but a shortage of offshore synthetic dollars that Japanese institutions required to roll foreign investments. A similar pattern emerged in Europe during the 2008 crisis, when the EU/USD basis blew out despite the European Central Bank providing abundant euro liquidity. The stress had nothing to do with euros. It had everything to do with offshore dollar liabilities that European banks had no way of meeting without access to swap markets. This reveals the first mechanical truth. Offshore dollar shortages form in FX derivative markets long before they appear in traditional indicators. Another key vector lies in the funding maturity structure of offshore balance sheets. According to BizData, over 60% of USD liabilities of non-US banks mature within 12 months, a ratio that has barely improved since 2008. Yet these institutions often extend multi-year USD loans or hold USD assets that cannot be liquidated quickly. The mismatch creates what the BIS calls a structural short-term dollar gap, which means banks must continuously borrow short to lend long. This gap becomes more dangerous when global central banks tighten policy. When the Federal Reserve began raising rates aggressively between SWAV 2016 and 2018, offshore funding conditions deteriorated sharply. Not because U.S. banks were stressed, but because offshore banks found themselves unable to match rising dollar obligations with corresponding funding flows. By 2018, the cost of hedging USD exposure for European banks rose by nearly 60 basis points, effectively wiping out profit margins for institutions that had relied on dollar borrowing to fund foreign investments. This forced many to unwind positions, triggering a sudden reversal in capital flows to emerging markets that had previously been supported by offshore lending. This is the second mechanical truth. Offshore dollar shortages propagate through maturity mismatches that become unmanageable as hedging costs rise. But perhaps the most critical layer of the mechanism concerns collateral. Synthetic dollars are often backed not by physical reserves, but by securities, usually high-quality liquid assets such as U.S. Treasuries. When volatility rises, the value of collateral fluctuates, forcing banks to post more margin. During the March 2020 crisis, the Treasury market, normally the deepest and most liquid asset in the world, experienced severe dislocations. Bid-ask spreads widened to 10 times their usual levels, and dealers refused to intermediate trades as balance sheets became constrained. The Federal Reserve's subsequent intervention, buying over $1 trillion in treasuries within weeks, demonstrated the magnitude of the strain. Yet the key insight is not that treasury markets malfunctioned. It is that offshore dollar creation relies on the smooth functioning of those markets. When collateral becomes impaired, synthetic dollar creation collapses instantly. The third mechanical truth follows. Offshore dollar shortages often begin as collateral shortages. These shortages can be triggered by changes in interest rates, shifts in risk appetite, or regulatory constraints like the liquidity coverage ratio, LCR, and net stable funding ratio, NSFR, which encourage banks to hold more HQLA onshore rather than making it available offshore. The result is a paradox. Regulation intended to strengthen domestic banking systems inadvertently weakens offshore liquidity. The consequences are profound. When collateral tightens, banks reduce FX swap activity, shorten lending tenors, and raise internal risk premiums. These micro-adjustments create systemic stress long before any public indicator registers a problem. The offshore dollar machine responds by widening spreads, increasing volatility in basis markets, and reducing rollover capacity. By the time swap line usage rises to did in 2008, when the Fed extended over $580 billion in swap lines to foreign central banks, or in 2020, when usage peaked at over $450 billion, the shortage is already well advanced. The central bank action is merely an emergency infusion to prevent collapse, not a cure. This reveals another uncomfortable truth. The Federal Reserve effectively became the lender of last resort to an offshore system it does not regulate. But the dependencies run deeper still. Synthetic dollar creation relies on the functioning of U.S. money market funds, which often provide short-term USD funding to foreign banks. When these funds retreat as they did in 2011 during the Eurozone crisis, reducing exposure to European banks by over 50%, offshore institutions lose a key source of dollar liquidity. The retreat forces them back into FX swap markets, increasing pressure on basis spreads and accelerating the shortage. This feedback loop builds until the system reaches a tipping point. At that moment, spreads widen not because of fundamental credit concerns, but because balance sheet capacity disappears. This disappearance is tied to global dealer constraints. Post-2008 regulations, such as the Supplementary Leverage Ratio, SLR, limited the ability of major dealer banks to expand balance sheets, even during stress. This created a structural limitation, the institution's best position to provide synthetic dollar liquidity. Large U.S. and European dealers became more conservative, just as the world demanded more offshore dollars. The result is an unavoidable asymmetry. Offshore dollar liabilities can grow faster than the dealer capacity required to support them. This is the foundation of every modern synthetic shortage. Further complicating the mechanism is the role of non-bank financial institutions, particularly in Asia. Large corporates in Japan, Korea, and Taiwan frequently borrowing dollars and hedge their exposures through FX swaps. When global interest rate differentials widen, such as during the Fed tightening cycles of 2018 and 2022, the cost of hedging increases dramatically. In 2022, Japanese institutions faced hedging costs that effectively raised their dollar funding rate to over 5%, even when domestic yen rates remained near zero. This created a squeeze. Corporates needed dollars for operations, but hedging made dollar borrowing economically unviable. The strain transmitted back into offshore banks, which are forced to absorb or pass along the higher cost. Through this channel, dollar shortages emerged not only from financial markets, but also from real economy funding needs. The mechanism extends deeper into emerging markets. Many governments and corporations borrow in dollars because domestic financial markets cannot provide long-term funding at reasonable rates. According to IMF data, over 70% of external debt is denominated in USD. When offshore dollar costs rise, refinancing becomes more expensive, pushing sovereign and corporate borrowers to seek short-term instruments. This raises rollover risk and increases demand for synthetic dollar hedging, intensifying stress in FX markets. A shortage here is not theoretical, becomes existential. Countries experience sudden stops in capital flows, currencies weaken, and foreign reserves deplete quickly. In 2015, during China's currency adjustment, the offshore CNH market saw funding rates spike to 66% overnight, a dramatic manifestation of synthetic dollar scarcity. The episode highlighted how fragile offshore funding can become when investor sentiment shifts. At the center of this architecture lies the invisible constraint that binds all synthetic dollar creation: the dependence on the future willingness of counterparties to roll exposures. The system assumes continuity. When that continuity is interrupted, whether by rising rates, regulatory tightening, geopolitical tension, or market volatility, the synthetic dollar supply contracts abruptly. The contraction is nonlinear. A small increase in risk aversion can lead to a disproportionate decline in available liquidity. This mechanistic tightening is why offshore shortages escalate so quickly. But the most important structural insight is this: offshore dollar shortages are not simply a function of supply and demand. They are the manifestation of balance sheet constraints interacting with synthetic dollar liabilities that have no natural maturity. Every dollar created offshore requires a chain of hedging, collateralizing, and rolling that must function flawlessly. If any link weakens, the shortage becomes self-fulfilling. Banks protect themselves by shortening tenors. Money market funds reduce exposures. Corporates roll hedges more frequently. Dealers widen spreads, and each defensive move amplifies the scarcity. The offshore dollar machine, once thought to be infinitely flexible, reveals its real nature. It is a fragile web of leveraged promises dependent on constant motion. If the motion slows, the web tightens. And when it tightens, the world feels a shortage not of dollars, but of the synthetic capacity to replicate them. This mechanism, silent, complex, underestimated, does the engine behind every modern offshore USD shortage. And it continues to operate today beneath the attention of regulators, policymakers, and the public, shaping global finance with every fluctuation in basis spreads, every recalibration of collateral, and every hesitant rollover in the offshore funding maze. What the world must understand about offshore dollar shortages is that they do not announce themselves with crashing markets, bank failures, or televised panic. They begin in stillness, in the faint tightening of funding lines across foreign desks and the softened glow of trading screens where numbers shift just enough for someone experienced to feel uneasy. The real danger of the offshore dollar system is not merely that it operates beyond the reach of any regulator, but that it conditions every major institution, from global banks to sovereign borrowers, to behave as if liquidity is always available, as if synthetic dollars can always be summoned through swaps, a repo, and cross-border claims. Yet the mechanism you have just uncovered shows that this confidence is not a feature, but a hallucination. The offshore machine works only until it doesn't, and when it falters, no government is large enough to instantly fill its gaps. What lies ahead is a future shaped by the same dynamic pressures that have defined every shortage for the past half-century. Rising global debt. Deeper financial interdependence, more complex hedging structures, and regulatory frameworks that unintentionally restrict the very balance sheets the offshore system relies on. As central banks continue tightening cycles or attempt to unwind balance sheets, the synthetic dollar engine feels every shift like a tremor. Each basis point of policy change rippling through a chain of liabilities stretched across continents. Even when conditions appear calm, the system stores tension. The mismatch between short-term funding and long-term commitments grows. The cost of hedging rises, and the availability of collateral fluctuates with every geopolitical shock. A single liquidity event in Tokyo or Seoul can force counterparties in Europe to recalibrate exposures, which then transmit pressure into Latin America or the Middle East. In this world, fragility travels faster than information. And because offshore dollars depend on the willingness of counterparties to roll exposures indefinitely, the next shortage will emerge not from collapse, but from a simple, universal human impulse. Self-protection. When one institution steps back, others follow. When one dealer widens, spreads, others match. When one market hesitates, the entire architecture echoes with the sound of quiet retreat. The next global stress event, whenever it comes, will not start where journalists expect. It will begin here, in the offshore shadows, in the basis markets and swap books that silently shape the financial world. You may not see it until it spills into the visible economy, until currencies weaken, funding costs spike, and central banks scramble once again to provide emergency swap lines that act less like policy tools and more like firefighting equipment. But when that moment comes, remember this: the shortage did not start on that day. It started years before, in the unnoticed decisions of liquidity desks, in the recalibration of balance sheet models, in the slow decay of confidence that synthetic dollar promises could always be met. The warning is not that the system will fail spectacularly, but that it will tighten quietly. Just enough to strain the most vulnerable institutions. Just enough to redirect capital flows, just enough to remind the world that the dollar's greatest strength is also its greatest weakness: its ubiquity. Every economy depends on it, yet no single authority controls the offshore supply. And in that paradox lies the structural tension that will define the next chapter of global finance.